Andrew Holland, Chief Executive Officer with Ambit Investment Advisors, joins us live. Andrew, good morning. Thank you for joining us. Andrew, what are you tracking closely? Movement in rupee, US bond yields, or what is happening to banks and other rate sensitives?
Well, I think they're all kind of very closely grouped together. I don't think anything from the Fed was of surprise last night, and obviously now the thinking is when they're going to taper is going to be in September, and it's really the extent of that. It's probably going to be towards the $70 to $75 billion. Started off a bit slowly, so it's not going to kill everybody, but emerging markets are going to continue to be under strain because of this. Because bond yields look as though they're heading towards 3% in the US, and that will keep oil prices high as well. So, unfortunately, currencies remain under pressure, which obviously pressurizes all of the central banks and emerging markets. And we've seen, with our own RBI making a policy misstep by increasing interest rates, which didn't help anyone or anything. And yesterday's move, whilst is a positive, and I view it as that. They're still trying to play that game now of okay, we'll keep short-term rates high and try and keep growth going because we're keeping the longer end a little bit lower. I don't think that's going to work either. I don't think you can play in between here. So a positive step in the right direction, but I think we're all now just going to focus on what the government have to do, and hopefully they'll move from being in denial mode and stop talking and start doing.
Andrew, hi, morning. What did you make of the overnight FOMC meeting minutes? Is it a given that come the September policy and Fed will start curtailing bond purchases?
I think it's a given that's going to happen. Whether it's in September is difficult. I mean, looking at the minutes, it says that some of the members, which obviously the voting members, still want to kind of see how the economic data is going, while some of the other non-voting members are keen to implement it. So I think, given where markets are, and given how the bond yields have risen in the US, they're probably best to start off in September, maybe in a kind of a milder manner than hopefully we're expecting. Say if they were starting December, so that would be my view. So nothing new or negative from there, just really confirmation that it will happen.
Andrew, what are the sound bites you're picking up from some of your institutional clients? I mean, when you interact with some of your clients, what is their outlook for equities per se now? I mean, are they nervous about India?
Well, India's been, as we've spoken before, the kind of cleanest shirt in the laundry basket, but now we're lumped into a different laundry basket, which is current account deficits and depreciating currencies. And we're at the top of that list. So I'm not saying everyone's thrown in the towel, but you can see from some of the selling recently in the high-performing stocks that there is redemptions out there, and when you get redemptions, you have to look at where you're making some money, and it's unfortunately going to be in IT, pharma, and consumer goods stocks, and so whilst we might get some positives like we saw yesterday, the selling of those stocks will continue to hit the index. So I still don't think we've seen the full kind of selling by FIIs yet. I think they're all, as we all are, hoping the government will take some steps to arrest the problems that we have. So they'll stick in there, but I think patience is wearing out, and the cleanest shirt in the laundry basket is a very old story now, of which is working for nobody.
So would it be, prudent to call a bottom at this time, Andrew, because we already have been staring and testing that 5250 mark. How much more weakness to go is, the obvious question that everyone's toiling with?
In terms of the index, what we've been trying to do is trying to avoid targets, because it's just where to avoid is really the key for the day or for the months ahead. But I suppose I would say this: if the government could come out with some reasonable policies that start to bring some confidence, then yes, we're probably towards the bottom. But if we don't, and we keep muddling around and we keep putting sticking plasters all over the place, then the currency will just keep testing and it will start to move towards 70. And so you could see an index below 5,000, that's for sure.
Andrew, not far ago, we've seen a print of 4,800 on the Nifty, and when Nifty touched 4,800, earnings were growing at about 8 to 10%. Rupee was at about 53, 54, and global liquidity was abundant. Currently, the macro situation is even more scary. Liquidity is going to be patchy, and earnings are unlikely to grow. So in terms of an environment, this is worse than 2011.
Yeah, I mean, in terms of where India is in the whole global scene, then yes, that's a more downward kind of downbeat kind of view of where India is, and that's being reflected. I think the broader market is really telling you what's happening with India Inc. And really where the levels are. So what I would see is probably that the index gets kind of lowered by selling in the favoured stocks which have performed. And maybe the broader market holds up a little bit more. My concern, though, Nikunj, is that the longer we leave things, the more problems which have been swept under the carpet will come up from under the carpet. And I don't think we're going to like some of those problems because it's going to hit the banking sector. We all hear what's going on in the real estate sector, and it's pretty scary out there. So it wouldn't take much for some of these problem loans which are being hidden at the moment to come forward. So that could be the only kind of leg down I could see for the banking sector. But at the moment, I think that the broader market has really reflected the deep kind of fall in the economy, economic growth. So therefore, I'm less worried about where the earnings are going and where we are, because I think we can get a V-shaped recovery if the government can, and it's a big can, do something to alleviate the fears that we all have and move away from our worst case scenarios.
Time to bottom fish yet then, Andrew?
It's tempting, and I'd love to say yes. We did a little bit yesterday, and that didn't really kind of work. So it's to my mind is I might as well wait. And if I miss the first 1-2%, I'm okay with that because you can always pick it up later. But at the moment, with so many variables and the fact that India has made some policy missteps, has really kind of spooked investors. And it's not just India, you've got Indonesia, Turkey, Brazil all out there as well. And any kind of misstep there could obviously have an impact for all emerging markets, including India. So I don't think we should just look at India alone. I mean, there's other markets and currencies which are actually doing worse than India.
Andrew, so are you buying right now with the assumption that you will get a strong trading bounce of about 10 or 15%, or you're of the view that valuations may correct by another 10-15%, but in terms of valuations we are nearing a bottom?
I think in valuations in the broader market we are getting towards that kind of bottom. I said I think if selling comes, it's going to be in the large stocks where investors have made some money over the past 6 to 9 months, and those are heavyweights in the index, so that will take the index down, and that's probably when I'd be looking at saying that you could have a stronger bounce from those levels. But am I playing for a 10 to 15% rally at the moment? The answer is no. I think the best you're going to get is 5% from here in any kind of short-term move, just in terms of a relief rally. But I think unless the government makes some moves which will give us more confidence that capital flows and the currency will stabilise, then those kind of relief rallies will probably be sold into.
In the near term then, Andrew, what is it that could send a positive signal domestically? Do you think it would have to be something more from the RBI, something more constructive, perhaps a diesel rate hike by the government, or do you think it is only going to be a global factor which could lift us off?
Yeah, I think there's three things actually. I think from a domestic viewpoint, this whole interest rate tightening was just going to choke the economy and cause more and more problems. So fortunately, the RBI's moved away a little bit from that and starting to reverse the policy. The government has to follow this up with a significant increase in petrol and diesel prices, and then look to attract foreign flows into India. Now, whether that's a bond issue or NRI kind of incentive, I'm not sure. They have to do something very quickly. And that would be, what I'd be looking for from the domestic scenario. From a global scenario, my thoughts are that the tapering probably won't be as bad as we all think. And so, we'll probably play very nervously towards it, and then, markets will say, well, it wasn't so bad, and it's not going to be devastating to global growth. And I think that would also help emerging markets. But I think you need both in tandem. And this is a September kind of story, rather than it's the end of the month story. So we might have relief rallies. Domestically, we have to take some action. No more words, please. And hopefully the global scenario will play out as I've just mentioned.
Andrew, really good chatting with you. Appreciate you taking the time out as always.